The Federal Reserve has made a big move. They've cut interest rates by 0.5 percentage point, a significant adjustment aimed at stimulating economic activity. This is the first reduction since March 2020, a time when the world was grappling with the onset of the COVID-19 pandemic. It's a clear sign that the Fed wants to make borrowing cheaper and boost the economy, encouraging both consumers and businesses to take out loans and invest. This move marks a turning point, indicating a shift in the Federal Reserve's monetary policy approach. It signals that the Fed is shifting gears after years of raising rates, which were initially increased to curb inflation and stabilize the economy. Remember when interest rates were sky high? Those were challenging times for borrowers. The Fed had to hike them to fight inflation, which was causing prices to soar and eroding purchasing power. However, those high rates also sparked fears of an economic slowdown, as borrowing became more expensive and consumer spending decreased. Now the Fed is cutting rates, aiming to reverse the slowdown and inject more life into the economy. This shows they're worried about jobs and the economy's overall health, as lower rates can help reduce unemployment and prevent business closures. Not everyone agreed with the rate cut though, highlighting the complexity of economic decision-making. Some Fed officials, like Michelle Bowman, voted against it, believing that the risks of lower rates might outweigh the benefits. This highlights the ongoing debate about the best way to manage the economy, with experts divided on the potential outcomes of such a policy shift. However, the majority decision to cut rates demonstrates the Fed's commitment to keeping the economy stable and preventing a recession, showing their proactive stance in these uncertain times. The Fed's decision to slash interest rates is driven by two main goals. First, they want to keep inflation in check. Second, they want to support economic growth. These goals can sometimes clash, so the Fed has a delicate balancing act to perform. Inflation has come down from its peak, but it's still higher than the Fed wants it to be. The rate cut aims to push inflation even lower, closer to the Fed's 2% target. Lower borrowing costs encourage people to spend and invest. This extra spending can help moderate price increases. The Fed is also concerned about a potential economic slowdown. While the economy has been resilient, recent data suggests job growth is slowing and unemployment is ticking up. The rate cut is meant to stimulate economic activity and create jobs. The goal is to prevent a more serious economic downturn. The Fed constantly faces a tough challenge. They must control inflation while also ensuring a healthy job market. This dual mandate requires careful analysis of economic indicators and potential risks. Lowering interest rates can boost economic growth and create jobs, but it can also make inflation worse. Conversely, raising rates can curb inflation but might lead to job losses and a slower economy. The Fed's current dilemma is finding the right balance. With inflation still above target and unemployment rising, the central bank must tread carefully. They need to adjust their monetary policy to achieve both price stability and a strong job market. The Fed has given us some clues about what they might do next. Their dot plot, which shows policymakers' projections, suggests more rate cuts are coming. The median projection indicates a total of 0.5 percentage point in additional cuts by year's end. Further reductions are expected through 2026. This outlook suggests the Fed is prepared to keep easing monetary policy. They want to support the economy and avoid a recession. However, the pace and size of future rate cuts will depend on new economic data. The Fed will be watching inflation and employment figures closely. The Fed's actions and projections have major consequences for the economic outlook. While rate cuts are meant to support growth, their success in achieving a soft landing for the economy is uncertain. The coming months will be crucial in determining whether the Fed's policy adjustments are working. The Fed's decision to cut rates has sent ripples through financial markets. Investors are still trying to figure out what the central bank's policy shift means for them. Stock markets initially reacted with a mix of ups and downs. Some indices dipped slightly while others remained relatively unchanged. Treasury yields, on the other hand, have shown a more pronounced reaction. Yields on longer-term bonds have risen. This suggests that investors might be anticipating higher inflation in the future, despite the Fed's efforts to keep it under control. The market volatility reflects the uncertainty surrounding the Fed's future moves and the overall economic outlook. Investors are closely watching for any new signals from the central bank. They're also keeping a close eye on economic data releases. This information will help them gauge the direction of the economy and adjust their investment strategies accordingly. Election year economics: rate cuts and the presidential race. The Fed's decision to cut rates comes just weeks before the presidential election. This timing adds a layer of political intrigue to an already significant economic event. The rate cut has sparked debate about potential political motivations and its impact on the election. Some critics argue that the rate cut is a political move. They believe it's intended to boost the economy and help the incumbent party. However, the Fed insists that its decisions are based solely on economic factors. They maintain that they are independent of political influence. Regardless of the Fed's intentions, the rate cut is likely to become a talking point in the presidential campaign. Both parties will likely use the economic situation and the Fed's actions to support their own arguments. They'll use this issue to appeal to voters. The Fed's mission: jobs and stable prices. The Federal Reserve has a crucial responsibility. Congress has given them a dual mandate: promote maximum employment and maintain stable prices. This mandate guides the central bank's decisions about monetary policy. It requires them to strike a delicate balance between these two, sometimes conflicting goals. Maximum employment means everyone who wants a job can find one, without causing runaway inflation. Price stability means keeping inflation low and predictable. This ensures the value of our money holds steady. The Fed's recent interest rate cut reflects their effort to achieve both parts of their mandate. Lowering borrowing costs aims to stimulate economic activity and support job creation. At the same time, they're trying to keep inflation in check. So, what's in it for you? Lower borrowing costs and your wallet. The Federal Reserve's decision to cut interest rates has a direct impact on your wallet. This move is designed to stimulate economic activity by making borrowing cheaper. This is especially true when it comes to borrowing money. Whether you're looking to take out a personal loan, a mortgage, or even a business loan, the cost of borrowing is likely to decrease. The rate cut should lead to lower interest rates on various loans. This includes mortgages, auto loans, and credit cards. Essentially, any form of credit you might need could become more affordable. If you're thinking about buying a home or refinancing your mortgage, now might be an excellent time to act. The rate cut could be good news for you. Lower mortgage rates mean lower monthly payments, which can make homeownership more accessible. You might be able to secure a lower interest rate and potentially save thousands of dollars over the life of your loan. This can significantly impact your long-term financial health. Lower interest rates on auto loans could also make buying a new or used car more affordable. This means you could drive away in your dream car without breaking the bank. However, the impact of the rate cut on savings accounts and other interest-bearing investments is likely to be less positive. While borrowing becomes cheaper, saving becomes less rewarding. Lower interest rates generally mean lower returns on your savings. This can be particularly concerning for those who rely on interest income, such as retirees. This could potentially impact those who rely on interest income. It's essential to review your financial strategy and consider other investment options to ensure your savings continue to grow. A brighter future. Seizing opportunities in changing times. The Fed's recent rate cut, while influenced by concerns about inflation and economic slowdown, presents both challenges and opportunities. This move is a response to the complex interplay of global economic factors aiming to stimulate growth and maintain stability. It reminds us that we live in a dynamic economic environment, where changes can happen rapidly and unexpectedly. Staying agile and informed is key to navigating these shifts successfully. It's important to stay informed, adapt to changing conditions, and make sound financial decisions. Regularly reviewing your financial plan and staying updated with the latest economic news can help you make better choices. While lower borrowing costs can make big purchases more affordable, it's crucial to borrow responsibly. Don't overextend yourself financially. Consider the long-term implications of your financial commitments and ensure they fit within your overall financial strategy. If you're considering a major purchase, carefully assess your financial situation and make sure it aligns with your long-term goals. Take the time to evaluate your budget, savings, and future financial needs before making any significant decisions. This is also a good time to review your investment portfolio. Market conditions can change, and it's important to ensure your investments are still aligned with your financial goals and risk tolerance. While lower interest rates might mean lower returns on some investments, it's important to maintain a diversified portfolio that aligns with your risk tolerance and financial objectives. Diversification can help mitigate risks and provide more stable returns over time. Consider consulting a financial advisor to discuss your specific circumstances. A professional can provide personalized advice and help you navigate the complexities of the current economic landscape. Remember, challenges often breed opportunities. By staying proactive and open to new possibilities, you can turn potential obstacles into stepping stones for growth. By staying informed, being proactive, and making informed decisions, we can navigate the changing economic landscape and work towards a more secure financial future. Embrace the changes, seize the opportunities, and build a brighter tomorrow. Please like this video if you found it useful and consider subscribing to our channel for more. See you in the next one.